profit's really a bit, it's theory. It's written down on a piece of paper, whereas the cash is the reality, because you can appear to be profitable on paper and you could still go out of business tomorrow.
The rosy glow of, setting up a business starts to pale into, oh God, how am I going to make the next quarterly VAT bill or payroll or whatever else it may be?
If you've got that just one single forecast, that doesn't tell you anything either. That just tells you one person's perspective on what might happen.
There's a broad guideline between passive accountants, i.e. the ones that are just doing compliance, VAT returns and so on, and the proactive accountants, the ones who are questioning what's going on in the business.
If building this financial resilience feels overwhelming, you don't have to do it alone. That's what we're here for. We can help you implement this. We do it every day. So welcome to Beyond the Business. I'm Chris Gault, Performance Behaviour Coach and Coaching Lead at CH4B. This series is conversations where we really dive into what drives scale. So through our conversations, we look at what shifts founders have to make in leadership and mindset, in funding decisions, succession planning, and the ecosystems that support their lasting growth. Today, I'm joined here by Jonathan Ratcliff. He's a fellow strategic business coach and a mentor at CH4B. And we're going to be having a conversation around cash flow forecasting and managing cash flow. And through this, we'll also take a look at a 3-scenario model that SMEs need within their business. So if you're ready to move beyond firefighting and build a business that's truly built to scale, you're in the right place. So Jonathan, thank you very much for joining me.
Good morning, Chris. Great to be here.
How are you doing today?
I'm very well, thank you, and looking forward to having this discussion.
Fantastic, thank you. So I'm just going to start, just to help the conversation flow, I'm going to throw a few hard truths and facts out there for us to start getting our teeth around, really. So a lot of conversations I have with people, they talk about their revenue and they talk about their profit, but profit's really a bit, it's theory. It's written down on a piece of paper, whereas the cash is the reality, because you can appear to be profitable on paper and you could still go out of business tomorrow. And a lot of that is obviously UK SMEs are owed £23.4 billion in late payments. And obviously, if you're not forecasting for bad client debts, etc., you're not dictating what's going to happen to your business. So there's a lot of things that business owners have to consider when they're running a business. It's not just the numbers on paper. What's your initial thoughts around those facts and that sort of theory that I put across there?
Yeah, I think this is one of the factors. In fact, it's arguably the biggest factor that most business owners, once they get into the business and start trading, they start to lose sleep over, because they realize the importance of cash within their business. And, the rosy glow of, setting up a business starts to pale into, oh God, how am I going to make the next quarterly VAT bill or payroll or whatever else it may be. And so this is predominantly one of the topics that comes up. And if it doesn't, then I raise it, because I'm, very often the business owners, if they aren't thinking about cash flow and haven't got their finger on this particular pulse, then the patient can die. So it's not great. So very often, and I'm speaking here, as I said to you in the preamble, I am not a financial expert. Finance, when I was a director in fast-moving consumer goods companies, I was reliant on other people to tell me, how is the business performing? What are the key performance indicators here? How are our finances working? What do I need to work on? And so on. And the same is true today. But given that this can be a nightmare for business owners, it's something that I raise regularly to say to them, how are you working with your accountant to get the information that you need so that you can sleep at night?
Yeah, and I think it's really good to be honest with those watching this conversation as well. We're not accountants. We are not telling everyone we are the expert in cash flow and in accounting, but we are very experienced through our own work, through working with other business owners and through using the CH4B framework, essentially, of making sure we deliberately look at profit, look at metrics, and how we protect our business, them being three of the principles that we use. And it has to be brought up, it has to be spoken about. A lot of people don't want to talk about money because it's either scary, embarrassing, or it's always been a bit of a sensitive subject. But the more we talk about it, the more important it is. Like you say, how are you getting the metrics you need? One of the things I always think is, do you know what metrics you need to look at your business? I mean, if I asked you a question, okay, in terms of finance, what do you need to know? What's the first thing most people say to you?
Turnover.
Yeah.
And it's typically what I ask them as well, so I can get an understanding of the scale, but it's the detail that that determines whether or not this business is going to be successful or not.
Yeah, that's it. You do need money coming in at the top, so you do need to look at revenue, turnover. I get that. Then you say to people, okay, so what's the next one you look at? And they go, oh, well, our profit. Have I ever got profit at the end of the day? Okay, good. So you've got money coming in and you've got on paper money at the bottom. Then they might talk to you about their costs in the middle, because often everyone looks at it and goes, my costs are too high, or I wish I could save some money here, there and everywhere. And then when you drill down, it's, well, why do you want to know that? Because I never seem to have money in the bank. Yeah. There we go, cash flow. But people don't go to it first. That's what I find from experience.
No, I would agree. And this is, we work very closely in CH4B with accountancy practices, but I often feel as though there's a broad guideline between passive accountants, i.e. the ones that's just doing compliance, VAT returns and so on, and the proactive accountants, the ones who are questioning what's going on in the business, providing them with management reports, providing them with cash flow forecasts. And you can guess which one I would prefer to be working on, because, but it's one of those false economies very often that business owners can make in the early days, which is, well, I'm being compliant and I'm getting my returns done and so on and so forth. Yeah, but you don't know how much cash you're going to need in 8 or 12 months' time. And that is how your accountant could help you, by providing a bit more of a granular information.
Yeah, people look at the accounts that have just been done, but that's what's happened. It's not going to tell you what's coming up, what's going forwards. And if people do look at forecasting, they go, well, it's just an accountant's job. It's a chore that the accountancy needs to do. They'll tell me based on last year, this is what you could do this year. But if you've got that just one single forecast, that doesn't tell you anything either. That just tells you one person's perspective on what might happen.
I always used to say to my salespeople, the only thing that's true about any sales forecast is that it's wrong. Okay, we know it's going to be wrong. This is a question of how badly wrong it's going to be.
Yeah.
So that's when you have to hold their feet to the flames and say, yeah, but is this really 75% deal done, or is it 25% deal done?
Yeah. And that's where I quite enjoy forecasting. It's one of my favorite parts of working with a business owner, because I use it as a strategic tool, and you get to play around with it. You get to play around with numbers. You get to tell yourself stories. Do you remember? I've read this book like this recently to my kids. Those books where you'd read, and then at the bottom you get to choose what page number you go to next.
Nice, yeah.
And then you go to that page and you read again, and then you go, right, now I'm going to this page. And the story would change every time you read the book. That's business. When you're forecasting, the story will keep changing. And that's why at the beginning I said we need this 3-model forecasting, because there's 3 models I like to do. The baseline of this is what's likely to happen. That's probably the one your accountant gives you. Based on last year, this is what's likely to be achieved.
Yeah.
But then I like to have a play around with the numbers, and I'd like to go, let's say everything goes tits up, to put it bluntly.
What's the worst term?
That's the technical term in business. What's the worst case scenario going to look like? And let's budget for that as well, because that's where you might have to start playing around with numbers, cutting costs. But then my favorite one is going, okay, where do you want to be? Let's talk about the outcome of where you want to get to, and let's work backwards from that. What does your forecast need to look like then? What does your business need to look like then? And you get your growth forecast. And when you've got those three together, for me, that's really exciting, because it's like, okay, we know this is where we've got to be, but this is what we're actually aiming for. But I can feel comfortable aiming for that because I have got a backup emergency plan as well. And it helps with cash flow. As you say, you don't know that 75% deal is actually a 75% deal. So you don't know that revenue is going to come in, but it helps you think about what you need to do to make it come in.
Yeah, no, that's good. So that's the 3-model approach that
Yes.
we can take. And do you want to share with the audience what sort of tools we use in order to go through that?
Yeah, I think it'd be worthwhile. I have a basic P&L forecasting tool, and it probably shouldn't be called a P&L forecasting tool. If I was speaking to an accountant, they might tell me off, but it allows you, it's based on a set of P&L accounts, and it allows you to set out what your revenue, your income, your turnover is at the top. Then it works out what cost of sales you might have to deliver those and gives you a gross profit line off the back of that. Then you can set out all your costs that you have. But I do it in such a way as I don't necessarily spread the costs out across the year like you might in a normal P&L. Well, I pay it there, but I'm going to spread it out so that in my accounts it looks like I've got a steady, flow of income. We do it realistically. We go, at what month is that money going to come out? And this is where the cash flow management element falls in. You've got your salaries coming out each month, but you've got that big subscription coming out in that month. You've got a big chunk of rent or ground service fees coming out there. You put them all in, and at the bottom that gives you your operating profit, I call it, because I don't bother going at this stage for strategic purposes into all your taxes and stuff. It's more your operational costs. What cash have you got in the bank to operate with? I will put a caveat on that. I do suggest you then take this to your accountant and get them to factor in what taxes you will need to pay, so you don't spend all that operating profit and not have cash to pay your taxes down the line. But it's a starting point for us to be able to then go, right, on paper, this is the money you've got coming in, the costs coming out, and what you'll be left with. And before we start playing around with the growth forecast of where you want to be, the first thing we can do is we can look at your outgoings and go, are you spending too much in places? Have you got costs that you don't actually need? Do you know how many businesses I've spoken to? Oh, I forgot about that subscription. I haven't used that for over a year. And I've saved, one business I know, they saved something like 10, 20 grand in a year by just cutting old subscriptions they no longer use.
Yeah.
So they finished the year profitable without increasing sales, just by cutting costs.
Yeah, another common mistake on the cost lines that I find, Chris, is that there's still a mindset amongst many business owners that if they need a resource, that resource has to be a full-time person, which might take 2 or 3 months to recruit, and then 2 or 3 months before they start to become efficient, and so on. The gig economy, the global gig economy, dare I say, now enables work to get done much more quickly at a far more efficient cost. And I think a lot of this started with a website or a service called Fiverr, which you probably know about, Fiverr, where you could get things like a business card or a LinkedIn header done by somebody very quickly and cheaply. And that has manifested itself now in specialists in lots of different areas, be that sales administration, general business administration, or a board director. You can pay by the hour, and certainly by the half day or day, rather than having to pay a 6-figure fee for a director.
Yeah.
So flexibility of thought is one of the key areas here, which again is where CH4B come in and play a part to challenge the traditional thinking
Yes.
on what those costs might be.
And there's so many people out there, as we're talking about, resource as a cost in terms of cash flow. Obviously, as you say, you've got Fiverr, Upwork, all those websites you can get a quick job done. We've then taken that a step further in CH, where we've got our expert partner network. So you can go out there and get someone who specializes in one area to help you, whether it be long term or on a project.
Of course.
Then you've got, do you choose to employ people PAYE or do you use subcontractors? But one of the biggest things, and you highlighted it, is people instantly go to, well, if I'm going to hire someone, I'm hiring 5 days a week. There's so many experienced, skilled people out there that actually don't want to work 5 days a week.
Yeah, absolutely.
You've got people close to retirement who want to scale back their hours. You've got typically mothers who have gone off to have children and they want to get back into work, but they don't want to work full time, or they want flexibility around the kids. People, sadly, when they pass the age of 50, or instantly people start going, well, shall I employ younger? They've got so much experience, these people. So actually, why aren't you being flexible in employing them? If they only want 3 days a week and you've got work that needs doing that doesn't take up 5 days a week, and you choose to go down the hiring route, hire those people, and it controls your costs. And you might find, as your business scales, either they choose to scale up their working hours as well with the business, or you get an additional part-time person alongside to do some form of job share. There's so many more options out there. And as you say, it's about having that flexibility, and forecasting gives you the visibility to do that.
I couldn't agree with you more, especially on that last point about an aging workforce. I can't think why. Anyway.
That wasn't meant to be my point, but I'll let you say that one. So yeah, I think that's a really key benefit to using these forecasts, is it highlights what cash you've got available, because your business, as I said earlier, may be profitable on paper, but if you haven't got cash in the bank, you can't pay your staff, you can't pay your suppliers, and soon you will find yourself in trouble. So that's why we need to do the first one, which is the baseline forecasting. If your business performs the same as it did the 12 months prior, you know what your turnover is going to be, what your costs are going to be, and therefore what's going to come out at the bottom. The next one I like to do, because it needs doing, but it's not as enjoyable as the final one, I like to do the worst case scenario next. Just, okay, if you were to finish, if business were to stop and you weren't having any turnover come in, how long could your business run for on the cash you've got without that income coming in? And that's where I introduce something I call Ripcord Costs. Essentially, from if you're jumping out of a plane and you're falling quickly, you pull a ripcord to slow you down. What are your ripcord costs? They are expenses that you can cut quickly out of your business. You can pull the ripcord and the price is gone. So every line on your expenses, on your outgoings, I like to work out what subscription are you on? What's the the get out clause, the cancellation, what's the cancellation costs? So you can work out also what's the priority. Are they essential to running your business, or are they a luxury? Is there another way of working? So you can work out the money stock coming in. If I pull the ripcord, these 4 costs come out instantly. These 2 I need to give 3 months notice on. So I need to be prepared to pull the plug. So that would be the next one I do, because I don't think enough people look at the terms of agreements that they sign and factor in, what if I need it to end?
Another common mistake associated with that is that they spend and invest when things are going well.
Yeah.
And, typically this could be things like, I don't know, a 3-year lease on a car, for instance. and then that person doesn't work out and it takes you another 6 months to recruit somebody else to replace them, all of a sudden you've got a car that's sitting around in the car park as an unused asset. And very often, things like building leases or car leases can be crippling when things don't go well.
I remember actually, and I'm going back a couple of decades now, when I was first getting into the world of work, and I got to drive around for about 3 months in a very nice car because a director left, and it was just sat around. So one of the directors went, well, you might as well use it for the next 3 months till we find their replacement. I was like, brilliant. An 18-year-old lad being given a very nice car. I'm like, I'll drive around in this for a while. So you're right. You've got to be, you obviously want to be optimistic and think things are going to work out, but just be realistic and just go, well, ask the question, what if? Sometimes you sign up to these subscriptions where you can pay monthly, or you can save the equivalent of £3 a month if you pay for it annually up front. Just weigh it up. Is that £3 a month, that £36 a year, the right amount? Now that's a small amount. You might go, yes, I'll save that. Scale it up, put an extra 0 or 2 on the end. Is it worth the risk, or do you pay monthly just for that? I guess that's security, even if it's for the first year. But you can map this into the forecast. What does it do if I do choose to pay it monthly rather than annually? And if I am going to pay it annually, I'm going to have a lump sum come out there in 12 months' time. Will I have the cash in the business to pay for it? Especially if at the same time your taxes are coming out. Because I'm afraid Mr. Taxman doesn't wait around. Your clients may be delayed paying your invoices, but Mr. Taxman wants his paid on time, please.
Death and taxes, dare we say?
Yes.
Certainties. Anyway, yes. There are things that people can do to mitigate some of these things, and the VAT man has been known to negotiate. I mean, squeezing blood from a stone comes to mind, but you don't want to be doing that every quarter.
No.
So, we are here not only to highlight some of the pitfalls and perils of not having a cash flow forecast, but when we talk to our clients about this, we can also encourage them to look under other stones and rocks to see what else. So, for instance, have they looked at things like funding? Are there any other funding routes? What sort of relationship do they have with their bank? And have they extended an overdraft facility to mitigate any of these cash flow blips that they're likely to be having?
Yeah, and Joel, we had a few weeks back, we had a conversation and on one of these videos, and we brought on Roy Linus, our accountant, through CH4B, and we actually had a conversation about different funding options. And like you say, there are options out there. Overdraft, you've got loans, you've got invoice financing. There's so many different choices, and as you say, that's what we're trying to make people aware of. If you are deliberately looking at your forecast and your finances and your cash flow, it's now within your control.
Yeah,
you can make informed decisions on what to do next.
I mean, the world of banking has changed so dramatically over the last 10 or 15 years. And there are now, as you quite rightly point out, Chris, we have a number of recommended suppliers within the CH4B portfolio who, in essence, can be challenger banks or challengers to find sourcing and help you to leverage the assets within your business, whether or not that's invoice financing or short-term loans, to help mitigate some of this. So we're not just there to hold up a mirror and say, have you thought about this? Or, you need to be doing this. We also help with the provision of some of the solutions.
Yeah. And that's where the third model is exciting, because that's when you start planning where the business can get to. This is when you start getting, what's your dream for the business? Where would you like it to be? And we can start using outcome architecture and strategic thinking to make it happen, essentially produce the plan. So where would you like the business to be in 12 months time? I'd like it to be a 30% growth on this year. Fine, let's just stick that in and map back. To make that happen, what do you need to come in at the top? Okay, well, that impacts your cost of sale, so that goes up a bit. And then you start looking and you go, but hang on, based on the size team you've got currently, can you produce that much volume of work? No. Okay, so we're going to have to add in a cost here. Go back to what you said earlier. Is that outsourced? Is that a part-time hire, a full-time hire? You don't have to jump into full-time hire. But also, to hit that revenue in month 7, the hire, and therefore the cost, may have to come in months 4 or 5 to get the team ready to be equipped and capable of doing it. So this is the strategic planning part. This is where you get to start moving things around. You go, okay, we're going to stick some money up here. It sticks some money down there. What's that done to the bottom line? Oh, I don't like the look of that. So let's just tweak this number here. And when you get it looking how you want to, that's when you can go, that's our growth plan. That's our strategic plan of where we got to go. Now you can give that to your team and you can say to your sales director, here's your revenue targets. And here's your budgets of what you can spend to get there. You may even choose, once you've got that, if you've, depending on how close you are with your leadership team, to get them to scrutinize it and contribute to it.
Oh, I would definitely do that, because otherwise you've just got a top-down approach saying, here's your budget plus 30%. And they're like, cloud cuckoo land. We've not been consulted on this. So you need to have, don't you, a bottom up as well as a top down, and hopefully there's a meeting somewhere in the middle.
That's it. Because you go, I need this much turnover, and I've predicted this is how much you need to spend to get there. And they go, have you considered that this person is needed as well, or this piece of software is needed, or once we get to that point, the cost of sale adjusts slightly, could be up or down. And if you get them involved, they take ownership because they feel like they've contributed. It becomes their plan. You still get to sign it off, but it becomes their plan. And suddenly you can allocate them to that metric. Okay, you're now responsible for that metric. So when we review these forecasts month on month or quarterly, depending on how often you do it, you're responsible. If that's on target, fantastic. And if it's not, I'll ask you what your plan is. And now I think the review is what's important. Like any plan, whether it be your business plan, a forecast, it's how often you look at it. Once you've set it out, I then like to produce one which is your actual plus forecast. So each month you plug in what's actually happened.
Yeah.
And it shows you this is what actually happened plus the next 11 months you forecast. So you can see where you might end based on that. So 3 months in, if you plug your actuals in and you're slightly behind target, you know that at the end of the year, you're either going to fall below where you said, but hopefully it's still above your baseline. But you can also then choose whether you adjust the plan to try and either make up that difference, or whether you just accept we're going to fall between baseline and our growth target, but we need to make sure we take some deliberate action to not hit that baseline.
What do you do about seasonality, Chris?
Seasonality is one of the most complex elements of forecasting. And I remember working in a business before where it was 67% of our turnover came between the middle of June and the middle of October in the summer. And we also needed 3 times as much staff in that time. So talking about the gig economy, we hired people that were self-employed, that were skilled in that area. We attracted them just before June. They worked for us through the summer. And typically they were people who then went off and they had a job that was winter seasonality.
Yeah,
and
sure.
That worked for them. And this is, I think, a stigma that sometimes gets put on it. Businesses, you know, it came about when people talked about 0-hour contracts and stuff. There are some people out there where this gig economy works for them. So as long as a business isn't abusing it and the people that they're attracting to work there, it's working for them as well. It's a really good way of managing the business. But it's no different. You forecast what revenue you've got coming in. You may look at it and go, we've got some constant costs. And so we need to allow for the fact that 6 months of the year, 7 months of the year, our profit margins are going to be smaller and our cash in the bank is going to be less. We're going to feel really rich in these months here. What you don't want to fall into the trap of doing is therefore spending all the cash. And that's where the forecast comes in. If you've got a seasonality business, you know you've got loads of cash coming in the middle here, but have you planned for the fact that that cash has then got to get you through the quiet period?
Mm.
You can't get to that point and go, yes, money's in the bank. Let's buy this. Let's buy that. Let's invest in this initiative. You've got to go, hang on, I've got to earmark this cash first. And this is where you would end up looking at potentially setting up separate accounts. So one of the things I encourage people to do, regardless whether you're a seasonality business or not, your revenue comes in and you immediately calculate off of the revenue you've just made what tax is going to be due, and you move that into and what that's going to be due, and you move it into separate accounts that you then don't touch until those bills come in. You could also have a reserve, another account, which is for seasonality businesses, the quiet month survival account, whatever you want to call it.
Mm-hmm.
But by moving it into a different account and not leaving it in your operational account, you're now not tricking yourself into spending that money. You're now going, now I've allocated it into these separate accounts so that it's there for the future because I forecast for it.
Yeah.
This is what I've actually got to spend. So that's what I personally look at when I'm sort of planning on those. Have you got any experience with businesses of season?
Yes, I have. And I think there's a good point here to be made, which is the timing of your year, is important, because if, for instance, you do, I'm working with a client at the moment who is highly seasonal around the Christmas period.
Mm-hmm.
But their tax year quite wisely finishes at the same time as, the normal tax year. So they've got time to recover and time to put money aside. But about 80% of their turnover comes between November and January. And so a lot of the rest of the year, they're actually losing money. Yeah. So I think you're quite right to be thinking about money that's being spent already or is already allocated. And it can be quite a nerve-wracking time whilst you're waiting for the season to actually happen. I was thinking about what business you were talking about, and I'm thinking it must be fruit, or it must be fruit and veg, or it's just, so will the harvest come in, is the equivalent. And in the client that I'm working with, the harvest now is more to do with e-commerce. Are people actually going to go through Amazon and direct online? Are they going to purchase in such quantities? Have I got my marketing messages correct? Did what worked last year, is that going to work again this year? So these are all things that we need to keep learning about and need to be challenged about. And I think the work that you've done, Chris, on artificial intelligence and are doing with artificial intelligence can really help some of the business owners that we're working with to think about how we can do things better, more efficiently, with the resources and tools that there are available. So I'm sure we'll be talking about artificial intelligence in future podcasts, but that's for another day, and we'll just highlight that as well.
Yeah, I'm not going to uncover that one yet, because you might not shut me up for another half an hour, and I don't want this video to go on forever, or people will stop watching.
Exactly.
I think what's really important is when you're taking action on forecasting, you need to make sure you're checking it regularly. It's not a non-negotiable, in my opinion. You have to forecast for your business, and you have to forecast as a minimum that baseline, that worst case scenario, and what you actually want, your growth model. And you need to review it regularly. And I think regularly depends on the business you're in. Personally, I would encourage everyone to review their forecasts monthly as a minimum. To some businesses, things happen so quickly, they may choose to do it bi-weekly, but monthly as a minimum, because it doesn't need to be a huge effort, a huge task. I don't want people thinking, well, I've got to find half a day to sit down and check my forecast. It could be 20 minutes. If you've got the right tools in place, the metrics get plugged in and you just take a sense check. If it's on target, it's in green, and if it's below target, it's in red, and you just focus on those reds initially until you get comfortable using the tool. But it's really important, because I have seen firsthand with business owners I've worked with that the moment you know what cash you've got in the bank and that you can afford the salaries next month, even if this client is a bit late on paying their invoices, and when your VAT bill comes in, you know you've got the money set aside to pay it, you sleep better and you stop reacting and firefighting and panicking, and you enjoy running the business again, and you feel you're not overwhelmed anymore. You obviously, don't get me wrong, there's stresses in business. I'm not saying just forecast is going to remove everything, but knowing you've got the cash there, that your business can survive and can make it through each month, releases so much pressure. Business owners I work with, they have a smile on their face. The moment they come and they open up, they enjoy opening up the forecast and going, look, I know where I am. And even though it may not look exactly what I wanted, I know the cash is there for next month. And I think that is my message to people. If building this financial resilience feels overwhelming, you don't have to do it alone. That's what we're here for. We can help you implement this. We do it every day. But if you're thinking, why should I do it? Better sleep, less worry, less panic, and just clarity over what's coming up is my message to anyone watching, of why you should think about forecasting. Not even think about it, why you should do forecasting in your business.
So in summary, if you've got a good proactive accountant, a good business advisor, coach, mentor, CH4B in case you're wondering, and have got a cash forecast or cash flow forecast and a financial forecast, you end up running your business rather than the business running you.
Great. And I think that's a beautiful way of ending on that. Obviously, if there's anything that people want to find out more about, they can explore the rest of the channel, that, you know, the YouTube channel. They can hit subscribe. There's plenty of information on there, and they can get in touch with us, Jonathan, with myself.
And shall we leave them? Shall we leave them with the top 10 tips on cash flow forecasting as well? The biggest mistakes most people make on cash flow forecasting.
Yeah. Have you got any you want to kick off with?
Well, I was going to leave it as an attachment so that people, because otherwise, you know, let's keep this short and punchy, but there's an attachment. If you want to find out what the top 10 flaws are normally associated with cash flow forecasting, God, get my teeth in after saying that. Then just there'll be an article that you can we can send you yes. If you send us your details.
I'll stick something in the description with the video so that people can get in touch with us and we can make that available. Jonathan, thank you as always for your insight around the topic. Hopefully, I'm sure people would have found some use out of what we've discussed today.
I hope so too, and it'd be interesting to get some feedback. But yeah, we hope that that's been useful, and yeah, let's look forward to the next one.
Thanks, Jonathan. Thanks everyone for taking the time to view.